Hi, this is Karen Lin. I'm your instructor of the semester of financial accounting. In this video, I'm going to guide you through how you can study the week 1 materials. You're going to study two main themes of accounting. The first one is how you understand the idea of a firm and the resources and the sources of resources of a firm in the language of accounting. And the second theme is the basic idea of financial reporting. So now let's start. Um, First of all, you need to understand every firm has a goal that you want to achieve. And to achieve those goals, you need resources to help you to get to the destination. For example, as a person, if you want to be a scientist, your goal is to be a scientist, what are you going to do, right? You're going to need food, you're going to need money, you're going to need to go to school, you're going to need the books and everything. So those are the resources that we are talking about in accounting. In economics, resources is defined as the things that you need to produce goods and services. That is linked to the goal of the firm, just like the money and the books that link to your goal to be a scientist. So now let's talk about where we are going to get those money to go to school, right? For a firm, there are three important sources of resources that could help the firm to get to their goals. One is from um, someone that invested in the firm. Um, I'm here. Let's use an example. For example, if you want to start a bookstore, what are you going to do to help you to fund to get to the bookstore, right? So you first of all you need to invest money in it. It's your own money. That's what we call the owner's capital, which means the owner's invested resources. Second of all, you could borrow from your mom. You could borrow from the bank. You could issue bonds and notes and so on. Those are borrowed resources, which means the money are borrowed from someone else. Finally, you would get money once your bookstore started, and you will earn some money because your business. That is called the management generated resources. So now, if you think about every firm's resources, like their facilities, their equipments, are all to be funded by three different sources. One is the owner's invested resources, the second is the borrowed resources, and the third is the management generated resources. So now let's look at what we have done so far. We look at every firm has a goal, and those goals are linked to the resources they need. If you open a bookstore, you're going to need books and shelves. If you're opening a search engine like Google, you need equipments, computers, and so on. So if you have different goals, you will need different resources. And those resources will come from the owner, the creditor, and the manager. What does an accountant do? We are accountants. What are we going to do? Uh, our roles are twofold. One is to record. We record the operations and transactions of the firm. Two, we report those transactions and the summarized results to the outside investors. And when we report them, we are basically answering a couple of questions. One of them is, has the goal been met? How does the managers use the funds and resources? Are they efficient? And does the management manager earn some money? Now let's look at financial reporting. When we think about reporting, there's an important equation that you need to understand. This equation is in a nutshell tells you the total dollar amount of a company's resources equals to the dollar amount of resources obtained from its sources of resources, which means the total resources a firm has equals to all sources of these funds added up. Again, go back to our previous slides. The idea is that the things that you need to fund you to school, the things you need for you to open a bookstore equals to money that you borrowed, the money you invested, your own, and the money you earned after you open your business. So let's take a look at a couple of transactions that so that you could do the rest. So I'm going to demonstrate 2, 3 transactions here, and you can help yourself to read through the rest. I'm using an example called Guitar Lessons, which is a company that teaches guitar lessons to students. So this is a service company. Basically, it does not produce, it just provides services. On August 1, the owner established a guitar lessons corporation by investing $7,000 cash. Now you can see this is a transaction. This is what we call a transaction. On the particular day, something happened to the firm. So this is the first day the firm establishes, and investors invested $7,000 cash. So how does this affect the company's resources and sources of resources? Now, if you recollect from my uh, lecture before, um, you realize this is something invested by the owner itself. So it's the owner invested resources. Now go back to our equation. Total resources equals your borrowed plus owners invested plus management generated. You will see the left-hand side is increased because the firm got cash. Okay, it's $7 worth of cash, $7,000 worth of cash, and it also increases the right hand side of the sources that invested by the owners. So now you can see every single transaction like this will have an effect on either both side of your equation or on the same side of the equation, which means you always have the equation equal on the left hand side and right hand side. So again, each transaction will have two effects. It would increase the left hand side or increase the right hand side in this case. Or it would increase one item on the left hand side, but also decrease another item on the left hand side. Then your equation is still equal. And vice versa, if you have a transaction increase one item on the right hand side and then decrease another item on the right hand side, then your equation is still equal. So this transaction, actually, the things that we just recorded answered two questions. Question one, what are the company's resources on August 1st? Obviously, the total resources is 7,000, and it's in the form of cash. And question two is, where did the company get its money from? You look at the right side of your equation, you see you get the money from the owner's invested resources, right? So the answer is that it's from the owner's investment. A second transaction is that on August the 4th, this is the second date, the company's manager paid $200 cash for supplies. Now, this is another transaction. You can see it all happens on the left-hand side because cash is one form of resources. Supplies is another form of resources. Now, remember, your equation looks like this. You have some things that you need on the left-hand side. The right-hand side reflects where you get the money from, right? So this transaction obviously does not involve anything related to where you get the money from. It is how you spend your money on. So it's all on your left-hand side. So what happened in August 4? The manager bought supplies, right? So we need to analyze how this transaction impact to our cash, and does the manager get anything? Yeah, of course, the manager spends cash and also get $200 of supply. So you will see the on August 4th, the resources on the left-hand side, it increases $200 because you get supplies, but it also decreases $200 because you spend cash. So the ending balance of this equation is that it's still 7,000 on the left-hand side and then 7,000 on the right-hand side. So more specifically, do you remember a few slides ago, we have when August 1st, when the investor invested money in the firm, we have $7,000 cash on the left-hand side, $7,000 common stock on the right-hand side. Now, after you bought some supplies, right, your cash decreases by $200. So at the end of the day, August the 4th, your cash becomes 6,800. Supplies will increase by 200. So when you add these two things up, it's still 7,000. Your right-hand side has the sources of owners' invested resources. So it's still 7,000, which means now you got 6,800 cash and 200 supplies. All these money are from the owners' invested resources. So now it's clear to us that all transactions has an effect to your company. It either affects both side of your company, like our first transaction did. It affects the left hand side and the right hand side on the same time. If that happens, you need to increase the total resources, also increase your right hand side sources of resources. Now, every time when you record a transaction to your firm, you need to stop. And after you do the transaction, you need to stop for a while and check your equation to see whether your equation is equal on the left hand side and right hand side. But on the second transaction, all the effect happen on the left hand side, which means cash decreases and supplies increases. They basically cancel out. The net effect is zero. So your left hand side still $7,000. Your right hand side is also $7,000 because of that. Now, remember, again, check your equation after you do each transaction to see whether they're equal from the left hand side to the right hand side. For example, I have students in the past, for some reason, they will decrease cash for 200. They will also decrease supplies for 200. If you do that, for example, then it would become 6,800 plus a negative 200 because they decreased their supplies, right? Of course, you cannot have negative supplies. That's one thing, but if for some reason you decided you do a negative 200 in supplies, then it will be 6,800 minus 200, that's 6,600, right? And your right hand side is still 7,000, so they don't equal to each other. Now you know you had made a mistake somewhere. So these are the two examples, two transactions I demonstrated to you in this video because I don't want to make the video too long. And you should go and do the rest by yourself and try them one by one, try the practice exercise, and then try the homework. They all help you to go through how different transactions would affect a company's accounting equation. So this is an accounting equation in its intuitive form. So what your firm looks like is that a firm is a bunch of resources that helps the firm to reach their goal. But where do they get the resources from, right? They got the resources either from the borrowers, from the owner themselves, and or from the manager who runs the business. Now you can see we don't say owners anymore because sometimes in a business the owner is not necessarily the manager. So we could have some like you could be investing in Apple by buying the Apple stock, but you are not really managing Apple. So these two things may be different. Unlike our bookstore case, you are the owner of the bookstore and you run the bookstore. So make sure you understand you have three sources of resources: borrowed, owners invested, and management generated.